Hey traders, welcome to a new trading educational video here on my channel. So today I want to talk about the concept of break even, meaning moving your stop loss to break even on a trade once you are in profit, and also the concept of moving your stops along with the price action in order to secure profits. Now, this is a subject that has a lot of different opinions, and I'll just show you what I have found from my strategies, what I like to do, and other concepts that I think are important and can help you to have a better risk management. If you haven't done so yet, make sure to subscribe, hit the thumbs up, all that good stuff to help the channel keep growing. And you can go check out my website for more information on all my updated 2022 trading courses as well. And so what I'm going to do, well, I have three charts here, three different markets that we're just going to go over some examples just to show you my thoughts on this topic. Let's first bring in the white screen. And so let's just talk about the concept of break even. So, break even means, let's say market is trending and you get back, let's say you get long here on a pullback and then it starts going your way. Some people, let's say you got in here and your stop loss was below this swing low. People will tend to, as soon as the market starts going their way, they'll just move the stop right here to their entry, because in their minds they think, okay, this is now what we call, quote, a free trade. Now I don't have to worry, because even if this collapses and comes back, now I'm not going to lose anything, or I'm just going to lose commissions or very little. So I see the point in that it does gives you peace of mind, especially if you're not actively watching the charts as well. However, many people, and I found too on my experience, have found out that a lot of times when you do that, markets will tend to, they can come back into their entry. Let's say you get long here, they can still come back into your entry, but your hypothesis could still be good, and you could have been stopped out on a trade that ended up going your way. Similarly, let's say if you have a market that's here, that's coiling, we have a support level and it breaks. Let's say you're a momentum trader, and let's say you got long like right here, right on the break of this support level that we had here. Well, where would you put your stop loss? Well, initially, the most logical place would be right behind the previous swing high before we broke structure to the downside right here. So then as soon as the trade would go in profit, a lot of people would then just move their stop loss and put it right here at the entry price. But why is this a bad idea? Well, it is a bad idea because this is a fresh level. We broke an important support level and we haven't come back to retest it. What do you think it's probably going to happen? Well, here, let's say here, I'll just put -1. This is where we got in. Our stop is here originally. And now let's say you're at 0.2, and at 0.2, you move your stop to break even here. Well, if this is a fresh level that market hasn't retested, what's the most logical thing that could happen? Well, we could expect this to come back, test this level, make a lower high, and then continue down. So if you had just moved your stop loss into here, this is actually the worst place you can put it. If we put a volume profile here too, this would be a high volume node here, and you would basically be putting your stop at the bottom edge of the high volume node. So in this case, what you want to do first is, instead of going ahead and just moving your stop to break even there, you just want to let the market either make some kind of structure here, and then if it continues, then we can move our stop behind the structure, and then over here we would have this, and then we would have a little high volume node here from this. So then, you know, you can move your stops beyond these areas. Or if we do get the pullback, you can either get in on a pullback into a previous area of support, now resistance. If it's a fresh level, it's coming to get tested. You would put your stop again beyond, just behind the last swing high pre-structure break. And then once you come in here, let's say the market comes in here, then let's say it might even come retest again. And once it breaks again here and just breaks structure lower, now this is your confirmation that this is a good solid level. Now, once this happens, this is when then you can bring and put your stop pretty much at break even, just behind this break-in structure, because then most likely market is going to come back and this level has already been tested. Okay, so pretty much this is the logic of it. You know, if you have a market and we're trending and you get long right here, and let's say you put your stop here, market continues to go here, and then you just move your stop to break even, well, there's a high chance market could come back to retest this previous area, this previous swing high broken, and basically do a retracement. You know, you could even put a Fibonacci here and everything, or use volume profile, all your confluence factors. But what the main point here is that when you are managing your stop losses, you want to first give the market a chance to actually make some structure, and then you can move your stop loss, because your stop loss by definition is where your trade hypothesis is invalidated. It's where you are wrong. So let's just go over 3 examples here and show you how it is better to just use your move your stop loss in relation with price action, and not just, you know, because you feel comfortable, because you just want to feel safe at whatever random level. Okay, so let's look at, this is Bitcoin US dollar, a 5-minute chart. So here we can see we have this swing high here, market trended down, and then we have this structure here. We have a little over under pattern, one of my favorite reversal patterns. You can see we make accumulation here, and then right at this point, this candle right here breaks market structure to the upside. So now let's say what we were saying before. Let's say you come and you got long right here, okay? And then let's say, you know, you want to shoot for this target. So the first logical place to put your stop loss, well, you could either put it all the way down here below the previous swing low, or if you're a little more aggressive, you can put it here just behind the big impulsive candle that broke market structure. Okay, so let's just grab the long tool here. So let's say you got here, let's say your target was here, let's say you take the more conservative stop and you put it right there. Okay, so now if you got long here, and now let's say market is over here, oh, and you say, oh no, now market is over here, I'm going to move my stop to break even here, and then you just go and you do like this. Well, then look what happens. Obviously, when we had this breakout, we left a little gap here. We have this resistance that's broken. It has not been retested. And if we even bring, just to illustrate, a Fibonacci here, you can see we get a retracement right into the 61.80% and also right into the previous level of resistance, now support. Because as you know, on a trending market, you go like this, price moves in waves on a nice trending market. And in this case, we made a higher high, and now we're waiting to see if we make a higher low. So in this case, if you just move your stop here, once we were like around here, because it make you feel safer, and also keep in mind we have a big resistance area here too, then you would have just been taken out and price came into here, and then it eventually went your way, and you would have had your stop originally here. So how would I have handled this? Or what would have been the best way to handle this? Well, in this case, you could either, if you're just waiting for price to come back, then the most logical entry would have been like right around here at the top of this box. If price already went without you, you don't want to chase it. So you're just waiting for a retest here. You could have gone long here, stop here, or more aggressive here. And then you can see that market bounces, and then right here, you can see we have this little swing high. Once we break through that swing high, that is my confirmation that now I can move my stop and trail it behind this swing low based on price action. So then here, I can just go ahead and do like this. And then just keep bringing it up and following logical price action. Like here, you can see we have this swing high. We break through it. We came back. We held. We went. So once I see this also confirming, okay, then the same thing. Now I take my stop loss here and I move it up here. So now we got it here. So now we had our entry here, and now our stops are in profit. We're targeting here, and now we get this. This is an example of now an early warning sign to just take profits. Or, I mean, as you can see, this is the whole root also of the debate. If you had just left this as you originally had it and you just did nothing, you would have hit your target eventually. But look what happened here. We came almost to our target, and then we gave back all this. It did bounce back and hit our target, but this could potentially have just come back here, So once we're here, like, and you're about 90-95% to a target, if you're monitoring this, you really want to just either drill down into lower time frames or just pay attention on your current time frame as far as signs for you to get out. In this case, I have it marked here. You can see how we've been making higher highs and higher lows, sorry. And then right here, you can see we come down, we bounce, and instead of here bouncing, we come down and we break below this. This is your sign to just get out. Like once we break here, you could cut your trade here, and you can see you still had your entry here and your stop loss, if you had trailed it at this point, would be right here, but you would have still closed in profit. So that's just an example of the trade management. Now, if you would have just caught this on the breakout like around here, same thing. Your R&R is obviously lower now because you went in on the breakout, but the same thing. Do not put your stop loss right here, because this is exactly the level we expect to be retested on a pullback. So you put it, below the whole swing low or below the impulse candle right here. And then the same thing. Once we break this high and we continue, then you bring your stop loss and now you put it behind here, and the same steps as above. Okay, so that is one example on a lower time frame. Let's go into gold spot, and now we can do one on a daily time frame. So let's say you're making a long-term swing trade. So this is the gold market, and here just same thing on this. Okay, we can see how price came up. We had sort of a falling wedge here. We had our breakout. Now, if you catch, for example, the breakout and you get in here, which I don't ever advise to just chase markets or chase price if it's left without you. Ideally, you want to catch a breakout, you know, right before it happens, because it gives you a more clear invalidation and a tighter R&R. But let's say you get in here. Well, first logical stop would be right here. Now, if I had not gone in here, or even if you got in here, I know that we have this, basically the last consolidation, the last move down before we went up and broke market structure here. So I know that there is a possibility this could have gone like this, and then it could have done something like that. So definitely you want to have your stop loss beyond this area. If we put a volume profile here, obviously you can see that this is a high volume node. So again, you just want to put it beyond the lower edge of the high volume node, right behind the low volume node support. Okay, so then let's say we continue here, and now you can see here we sort of start coiling over here, making higher highs, lows, and we have a breakout here. Same scenario again now. If you, let's say you get in here and you put your stop, I don't know, let's say you put it right here, if you're more aggressive, right below the last move down before the breakout and break of this resistance here, or you could have done here. But if you put it here, this whole box is an area that is highly likely it will get retested at some point. You can see strong resistance, clear breakout will leave a gap. So you either can sit and wait and set your limit orders to buy somewhere in this area with your clear invalidation below this clusters before the breakout, or if you got up here, then the same thing. You have your stop loss here. Once price comes up, we have this consolidation and we break into a new swing high, then we can move our stops right here. And then in this case, you know, same thing. You can see once this swing low breaks, I would have cut the trade right here, or you could have just, you know, gone taken out here in profit. But then you can see how here we came down, tested the level, and again, this is another thing. Just because price comes and tests the level once doesn't mean it cannot come test it again and that it's not going to hold. You know, if you come and you got long here and you got your stop here, and let's just put our little tool. Where's long position? So let's say you got in there. Let's say you're targeting this previous swing high. Your stop is here. Oh, sorry. Right there. Okay. So let's say you got in there. You know, market bounced, but same thing. We have a big resistance here untested. So if we're like right here, and then suddenly you move your stop to break even here, what happens? Market hits this resistance, comes back, and retests the same level you would have gotten taken out here, but then market just continued up. So your idea wasn't invalid. You want to first have some sign from price action to let you know we've made some kind of structure here to protect your trade behind. So let me just make this bigger. And then in this case, you can see we had our entry. Just move our entry to the top of the box here. Okay. We had our trade there. So then here we got our entry here. Market goes, hits this previous support, fills in here, rejects. We come back again for a second bounce right at our entry. And now we start, similar to here, we start forming an ascending triangle, and look at the amount of hits this resistance has. When price starts coiling like this, making an ascending triangle, and I'm not like big on classical chart patterns. I don't think, they're totally reliable. I only use them as confluence, always with price action and volume profile. But once I see that we have this breakout here, we break this structure and we go back above this support, resistance, and now we're back above, then this is the moment. Once you get this confirmation, then you bring your stop, just beyond the swing lows, or well, if you want to be even more aggressive, maybe like up to here. So then that's, when you go like this, and now you have your stop loss in profit, and then you just let the market ride. And in this case, you can see it didn't even create any structure because it just pretty much shot up, and then it would hit our take profit. Okay, but that's another example of how we can use the evolving price action and structure to help us guide our stop loss trailing, and how it's not always convenient to move our stops to break even. Okay, and then finally, let's see an example of the S&P 500 on the 1 hour chart. And you can see right here, we had market came up, then we start bouncing over and over from this support level. We are making lower highs, so market is compressing to the downside, and we have this breakdown right here. So let me just zoom in. Okay, and so same scenario as we talked. If you got into this trade like right here, and let's say you had your stop loss here in the beginning, and then the market starts consolidating here, and you just decide, oh no, I'm gonna bring my stop loss to I'm just gonna bring this to break even, like right around here, and it's gonna give me a free trade, and then if it falls, great. If it comes back, I don't lose anything. But this is the worst place you can put it, because this is a huge support level that has not been tested. Now, we can see, obviously, this is a 1 hour chart again. We can see that the trend was so strong that we did not get even any pullbacks. So I probably might have just been left behind on this trade, because ideally I would have set a limit order right here to sell. And I would have put a stop probably like around here, because when we're here, I'm expecting this to do something like this. Just come and then just, continue down. But you can see that this trend was hugely bearish. So what do we do in this case? If you had gotten the breakdown and you were here, I would have my stop loss here. We come down here. We start consolidating. Once we have the next confirmed breakdown, then you bring your stop beyond the structure. Same thing here. We come, we consolidate, we break down here, then you bring your stop behind this, etc. And then you just keep moving it with price. If we would just put a volume profile here, let's say just here into here, just from there to there, you can see how you can also use the volume profile, and you can see how we make little high volume nodes in this. And once you have the breakdown, then you want to put your stops behind the high volume nodes that are forming as markets continue their trend. Same thing here, we have this high volume node here, so then you would move it just beyond here on a confirmed breakdown, etc. And the same thing we talked about before. Let's say you're targeting this swing low right here. So let's grab the short position. Let's say we managed to get long short right here. Our stop was there originally, and we're targeting this here. Okay, so if market is coming here, and let's say we're at this next swing low here, no, sorry, not that one, but let's say we're like at this point right over here. If price would start consolidating or something, I mean, look at now the amount of profit we have with the amount of profit left. This is where you really want to just tighten and bring your stop, just beyond previous up moves or previous consolidations before the continuation of trend, because it did go to target. But do you really want to risk this whole profit if market just starts sort of consolidating here and then suddenly making a higher low and a higher high, etc.? Obviously we want to just cut it right there. Okay, but in the scheme of things, we can see how we do not want to ever move stops to break even if we don't have a logical structure to protect us. Like in this case, if we would have gone like this, and then we go like this, and then we break and make a lower low, this confirms this is a strong level, and then you bring your stop here. Then once, like if we go and we do what we did here and we break down, then we bring it behind here, etc. So that's pretty much sort of the process and the guidelines that I use when it comes to moving my stop losses with the markets, and how just using your evolving risk reward ratio to secure profits, but also use logical places in order to secure them, and how you can use price action, volume profile, market structure, all these different factors in order to assist you when it comes to finding your best protection areas. Okay, that's pretty much it. Thank you all for watching. Make sure to subscribe, hit the thumbs up. For more information on my courses and everything, check out my website, and I'll see you all in the next video.